All right, so in this chapter, we're going to talk about accounts receivable. And one of the things that we look at in the revenue process is recognizing the sale when the delivery of an item is complete. So in many cases, we may have the delivery of an item, but we may have not received payment in full and worked out terms with our customers. So we're going to talk about how we recognize revenue with respect to accounts receivable, and we're also going to look at the different types of accounts receivable. So let's go ahead and hop into this chapter. So accounts receivable is claims against customers from a sale of goods and services. So when you consider a sale, that means the revenue delivery or the delivery process of the service. The service is complete or mostly complete in many cases, and the goods have been delivered. That would be the claim of an accounts receivable. The other thing we have in accounts receivable are intercompany loans, either loans to officers or employees of the company. Loans to subsidiaries. So in advanced accounting, we'll talk about how a company can be owning a portion of another company. That would be a subsidiary. And in this particular chapter, we'll talk about the loans to the different subsidiaries or the partially owned businesses. We're going to look at claims against various other refunds. You could have claims for tax refunds, or you can advance to suppliers to receive goods, and that could also be considered as an accounts receivable. Now, on the balance sheet, the accounts receivable is shown at its net realizable value. All right, so let's look at the different sources. So sources of notes receivable. We're going to talk about notes. So a note would be when you have an accounts receivable and you go ahead and sign on for specific terms of payment. So you would have, or you would sign a contract with specific terms, usually rate and time. So the nature of notes receivable is it's usually substantial. It's not just a little item or a little item on account. It can be an installment note, or it can be a contract that will allow the seller to hold lien on the goods. So for example, if they wanted to take a financing statement against some goods in a sale for a customer. So let's say you have a farmer, you go in, sell the farm equipment, and then have the farmer sign a note receivable, and then of course they would use their harvest or income from the farm equipment to pay it back. There's also loans to any subsidiary. They can have a loan. Let's say you go in and buy 20% of a company in equity, and then you also you pay the rest in loan. Maybe you want to keep your relationship less equity. And then finally, loans to officers and employees.
It's time for your call.
So when we talk about the audit risk of receivables, one of the things that we talk about in audit risk is if they've had any incidences of fraud with their overstatement of receivables. So they might have been in a position where they were a little bit aggressive with recognizing sales at the end of the month, or they signed up some customers that were obviously not going to be able to pay. So they're a little more overstated with the performance of a revenue impact on their balance sheets. The other thing that they talk about is complex accounting rules. So a lot of revenue, we think about revenue being the delivery of a product or service. But let's take an example. Let's say we have a situation where we are building a huge jet plane. Well, it may be years before they deliver that plane. So what happens is they recognize the revenue based on percentage of completion. And that's an area that can get very complex. So if you're going to be dealing with something complex, then what you're going to do is raise up your audit risk and recognize the intrinsic risk behind that engagement. The next thing is revenues and receivables are significant to the valuation or use significant accounting estimates. So I go back to an example I used a couple years ago when there was a busy doctor's office that had quite a percentage of medical write-offs. So if you have a situation where you're going to have a lot of write-offs with your receivables due to customers' ability to not perform or not pay their bills, just the nature of the industry, then you would have to expect higher audit risk. So the objectives for the audit risk of receivables, you want to go in, and this is kind of, you'll have to forgive my lineup here. You're going to understand the client and consider inherent risk. And we talked about inherent risk in the environment. An environment where you're having to make estimates is always going to have a higher inherent risk than an environment where it's pretty cut and dry. And then an environment also, if you have a very difficult delivery of performance obligation, and I'm thinking in terms of things get a little shaky with software as a service and service plans in general. So those types of performance obligations are going to be complicated to satisfy, and so you have to raise up your expectation of audit risk. And then of course you need to look at the internal control over receivables. Who is adding or booking a receivable into the journal? Is there a separation of duties? And then of course once you go through these first two objectives, the third one is to assess the risk of material misstatement and design the test of controls. So you're going to do substantiations of the existence of the receivable and the occurrence of the revenue transaction. Did the receivable actually get booked? Did the revenue transaction actually happen? Was the product or service delivered? And then you're going to go through the completeness of the receivables and revenue transactions. Were they all booked from start to finish into the financial statements? And then you're going to look at the cutoff of direct revenue transactions. Are they booking a lot of sales at the end of the month near the cutoff date? Then you're going to want to go through and verify all those sales. And then determine that the client has rights to be recorded receivables. So we'll do a verification with the client, make sure that the client actually has the rights to the property that they have, the receivables that they're recording are actually legitimate. So you can read through those, but it's important to think of it in terms of the big picture of revenue revenue satisfaction of delivery. So just think that obviously you're going to assess the control environment and look for that tone at the top, looking at the independence of the board, looking at the HR function and their commitment to have competent employees and how they're holding employees accountable. And then you're going to look at the risk of misstatement of revenue that is very complex in nature, and they have complex rules regarding revenue recognition. That's really what got Enron in trouble, is the complexity of their revenue recognition policies, and they tend to be very aggressive recognizing things that were not actually should have been booked as revenue. And then of course you'll look through the control activities, the maintenance, and so on and so forth, and monitoring. Now let's look at the documents, and it's important, I think, to know the documents in the order of which they are going through. I think it would be good for your notes to go through and just take a look at this flow chart and the order in which it goes from purchase order to shipping. Just know like the order of the credit sales flow chart. I think that would be very helpful for the CPA. And then of course, is there going to be internal control over notes? Remember, notes are different than accounts receivable. Accounts receivable are just open credit accounts. Notes have terms, rates, conditions, and so on. And some have legal binding. I guess maybe all would have legal binding. I don't hop in the business law section. So the big one here is to make sure that the defaulted notes are signed by people that should be signed. So the audit of receivables, you're going to You're going to get understanding of the client and the environment to measure that overall audit risk, including those inherent and fraud risks. Remember, that makes up your overall audit risk. If you've got a complicated client with complicated transaction, you're going to have to set that bar a little higher and then lower your detection risk and do a lot more substantial testing. You're going to understand and get an understanding of the internal control over receivables or revenue, and assess the risk of material misstatement when that's done, and decide further substantive tests. Now, when you're trying to understand the client's business, a lot of it goes into the products and services sold. And one of the things I would say is looking at the ticket item and the ability for theft and misstatement in inventory itself. So when you're looking at the types of products and services sold, you want to look at, like, how easy is this to trace back? Are the clients going to verify what kind of product line are we in? Is there a lot of estimation? Which you run into with, like, software as a service. Look at the demand. Is it seasonal or cyclical? And then, of course, if seasonal, as we reach the end of the season, look for those cutoff dates. Look at pricing and sales returns and allowances and extension of credit. So are they very generous with their credit? Do they expect a lot of write-offs? How is delivery done? I mean, you really have to go in and check. And then the second to last one's kind of important. How is the compensation for the sales staff? And if it's based on revenue, then you're going to be in a situation where you're going to have sales staff and staff that's incented to make as many sales as possible, no matter how they make the sales. If it's based on revenue, that they're going to want to be booking revenue. So you're really going to have to look at how that translates when you get closer to the cutoff date. Are they incented to aggressively book sales that they don't necessarily even should be making, and that sort of thing? All right, the fraud risk related to receivables and revenue. So you have to make sure that you have controls implemented, and looking at the way, but sometimes, you can really look at internal control, and if your internal control is weak, you may find fraud with receivables and revenue recognition, because people will use kite or use receivables to basically lap, where they go in and they pay one receivable and then they just create a new one. They keep lapping the money, kind of a kiting type thing, which might end up eventually creating a big loss for the company. So they look at the different misstatements, the ones that I said. Recognizing revenue not earned is one example of a potential misstatement. In other words, making up fictional sales and then turning around and backing them off after the cutoff date. Mistakes, early recognition or late recognition of revenue. So cutoff problems is a big one with receivables. Holding the sales journal order to get a sale on this year so that you can make a revenue goal, or recording sales in the wrong period based on incorrect shipping information. So maybe recording something that is let's see here, FOB shipping point as a destination, or back and forth. I mean, there's a lot of ways you can do it. All right. So let's go into additional tests. Once again, you can go in and do samples. You can sample the sales transactions once you get close to the cutoff date. I'd be looking at every single one. You could look at your IT application and examine evidence of review and approval of estimates. So if you have somebody that's making the estimates of both revenue or write-off, you want to see if that person's pretty close or how far off they are, because that'll make a difference on the financial statements. All right, and then here here they show in this figure the relating the controls to the financial statement assertions. This would be something to look at. It feels very much like a multiple choice question. So I'll read one or two. I would just take some time to read through one of them. I'm just looking here. Mail monthly statements to customers and follow up on the errors reported. Observe and make inquiries about mailing statements and review the evidence of follow-up is a typical test of control. The reason why you want to mail monthly statements to customers is if a accounts receivable officer or administrator is fake paying their accounts receivable or posting payments on the wrong accounts and then reopening new accounts to make the payments and going back and forth like that, the customers will call and complain about their bills because their bills will end up being wrong. So if a customer says, hey, you didn't post my payment to accounts receivable because instead they cashed it or posted it somewhere else, that's where you'll catch that. And so when you look at the typical tests of controls, those are also places where you'll catch problems. The whole idea is to catch fraud. So this is where you'll open up the door for some of these. All right, and again, they go through another list of substantive tests. Again, I would read through those and have those ready on your note card for CPA exam and so on and so forth. So when you have an accounts receivable and you have quite a few, you should confirm your large receivables with the audit client's customers. So you would actually go to the customer, send them a confirmation of, hey, do you have an accounts receivable with this particular audit client? And then wait for the client to come back and let you know. And you wouldn't think people would fill these out, but you'd be surprised. I've sent tons of them out, and they always do. You do this with the large audit clients' customers, not anything that's immaterial. And then you can also, if you have a low risk of inherent and control risk, you can kind of go through and you can come in and you might not have to confirm the confirmation. So here's the process of the confirmation. CPA determines it. I used to make these things, deliver them, and then they receive it. They confirm, they deliver it back to the audit, and the auditors and the CPA receives the confirmation, the response. Okay, so there's two types of confirmation. There's the one where you have to get the client that has an accounts or the customer that has accounts receivable to mail you back and say, hey, guess what? I do have an accounts receivable. Or you could send out this thing called negative confirmation. That's called a positive confirmation. In other words, customer writes you back and says, yes, I actually have an accounts receivable with your audit client, and this is how much I owe, and so on and so forth. And negative says, hey, guess what? We're going to send you a confirmation. Look at it. Maybe you don't even open it. But the only way we want you to write us back about it is if there's a problem or if the balance is wrong. So you can basically get this negative confirmation if you're an audit client or an audit client's customer. Open it up and say, okay, guess what? There's no problem here, and then just toss it in the trash. So you would only, now which one is going to give you more assurance? The positive confirmation, because you're asking people to write you back. Negative confirmation does not give you the same amount of assurance because it may not even get opened, and you don't follow up with negative confirmations. You would follow up with a positive confirmation. And again, you would use a negative confirmation if the control risk is low and you don't have any issues with your client. Okay, so again, here is the flow chart of the confirmations. Let's talk really quickly about data analytics. The beauty of data analytics is you could look at someone's output, and you could start sussing out problems based on just looking for outliers, looking at areas that are way off on revenue or things that look unusual. So you pull all the reports, you put it on a graph, a beautiful tableau, and then you just go after it. And you can also look and use data analytics to find related party transactions, duplicate billings. In some cases, you can use data analytics to find every single billing out there and take a look at it. So that's a pretty powerful tool. And you can basically just take your report, say, I want you to go look for this and that, and go after it. All right, so the steps for revenue recognition, you're absolutely going to need to know these. And I think you need to write these down in your notes. The first one is this: you identify that a contract has actually been taken place. All right, sometimes you don't have a contract and the sale is not complete. You're going to identify the performance obligation. Sometimes that can be very complicated. Remember, we talked about software as a service and the different revenue performances. You maybe buy a service plan. Those get very sticky. Determine the price, which may be, if you're on a service plan, it may be allocated over the life of the plan, or you may never use it at all. And then allocate the transaction price to the performance obligation. And then when you finally have the performance obligation satisfied, and not a moment sooner can you recognize the revenue. So you should know this. This is actually in the code, so make sure you've got this one down. FASB 606. I was going to try and name the code, but I couldn't even remember the number I was looking at. All right. So here are some revenue recognition problems. Sales with an unusual right of return. So it's a great example of Diebold. Diebold had this thing where they were allowing the customers to try the things out almost to the point where they could send them back at any moment, but then they were still recognizing the revenue. And so it was a very unusual right of return. Sign agreements, like you go ahead and let me send this to you, and then you can send it back, and I'll get you some money off on the next month. Franchise fees, very difficult to recognize. Bill and hold, so I'll bill you, but I'm not going to, that's another one where I'm not going to send you the product for a little while, and we'll just hang on. Sales using unusual interest rates, right? Either exorbitant amounts. And then long-term construction contracts, we talked about those, where we had the situation where we might be building the jet or the construction project over several years. So we have to recognize partial completion. Multiple element agreements. And then also revenue recognition that involves estimates, where you have to decide whether or not a certain number of, there's so many ways. So you really have, these would be the one with lots of estimates would be the higher level of audit risk. Now, we probably remember from Accounting 101 allowance for doubtful accounts. So you definitely want to go in and look at that allowance and how the estimate was made. And I used to say in my 101, my Accounting 1 classes, I would be like, oh, management gets together and has a meeting based on what they did last year, and they use some great estimates. Well, it's really important that they get that estimate right, because it affects revenue, and if it's way off, then it can be looked at as a financial statement issue. So related party transactions can be both people that are related in through conflict of interest, but it can also be between parent and subsidiary relationships. And you have to look at percentage of ownerships and interesting transactions. Okay, and so we wrap it up with audit documentation and the different items that you're going to go through. One of the things I want you to drive away from this week is to start thinking about the complexity of revenue recognition, and maybe even do a few Google searches of your own of relevant cases with accounts receivable. I particularly remember a case where I had a friend that was forging accounts receivable for customers. They had opened up an account for several customers, and they did not report the accounts to the credit agency. So when a customer would walk away, they would just take the final payment and slip it into their pocket, and then write off the customer's account, and then eventually delete the account. So this person did that for several years. I did not know of that. Well, I knew this person, and then they ended up going to jail over it. So it is very serious, and it's something you definitely need to watch out for in your accounting career. Also, very important to know this chapter while studying for the CPA. So have a great week, everybody, and I look forward to seeing you on our check-ins. Take care. Bye.